Good morning. Welcome to your program, your darling program called You and Tax. I remain your darling host, Olalekan Eric Joshua Oluwakayode by name. Today we will talk about what the meaning of taxpayer identification number, the kind and the type of tax we have, and how it affects your business. Either you are a business name owner, or you are a limited or unlimited liability company, or you are incorporated trustee. So what we mean by taxpayer identification number is a unique number being given to you by tax authority. We have two types of tax authority. We have the federal tax authority and you have the state tax authority. The federal tax authority is being called Federal Inland Revenue Service. And from next year, their name will be changed to Nigerian Revenue Service, while we call the tax authority of the State Inland Revenue Service. So tax identification number is a unique number given to you to identify your company or to differentiate your company from another company, no matter how your name is similar or the number stand you out. So whenever you are doing your business transaction or you are communicating with the federal government through your business name, your company name, or you are communicating to third party through your company name, that thing distinguish you from another company. And once you have a thing, it make it easier for any company, any third party, either a company or government or external country or outside the country to do business with you. It made you to be a legal entity in the country you are. So once you register your company with the Corporate Affairs Commission, the law grants you a 6 month day of grace to register your TIN with the Federal Inland Revenue Service. Once you fail to do that within 6 months of your registration, the law will penalize you for registering your taxpayer identification number late. There is a penalty for that. So we implore you immediately as you register your company, try to visit any nearby Federal Inland Revenue Service to get your unique tax number, which we call TIN. And this thing will enhance you whenever you are opening a bank account or you are transacting with a third party. And also for your personal identification number, you get that from your State Inland Revenue Service. It has been made easy now. You can register for your personal identification number, which we call PIT, on the website of Joint Tax Board, or you visit any state you reside. You visit the State Inland Revenue Service of that state to register for your thing. So let me discuss about the registered business owner, either limited or enterprise. Once you register your company with the Corporate Affairs Commission, you are expected within 6 months to visit Federal Inland Revenue Service to register for your TIN. And once you get your TIN, it enables you to open a bank account and to operate freely in Nigeria. And that is what we call VAT letter, which is value added tax letter. And some people call it value added tax certificate, which is called VAT certificate. It's the same thing with the VAT letter. What it means is the letter from the Federal Inland Revenue Service, which indicates your TIN. It's your taxpayer identification number as a company will be stated on it clearly. Once they register you for TIN, you became an agent of government automatically to help government in collecting VAT from every person you are rendering service to, or from any company or person you are selling your goods to. So you as a registered business owner, once you register for your TIN, you automatically becomes a federal government VAT collecting agent. You collect on behalf of the government each month and you remit it to the government at the end of the month. Once you finish, let's assume you are in the month of January. Every sales activities you sell in the month of January, you help government to charge VAT on the sales price of your goods, which you collect from the customer you are selling the goods to, or the customer you are rendering the service to. And at the end of the month, which is the beginning of February, you remit it to the government. VAT ought not to come from your income or from your sales. You are a collecting agent which you collect from the customer and you pay to the government. But failure to charge the customer VAT, that means your company will bear the burden of paying it from the capital or from the profit of the business each month. So, well, now we have, let's talk about the type of taxes we have. We have two type of taxes. We have what we call direct tax and we have the one we call indirect tax. Direct tax are the tax you pay directly either from your income or from the profit of your business. You as an individual, either employee or business owner that you are getting salary from your business, you pay personal income tax directly from your salary. And any tax you are paying directly from your salary or from your income or from the profit of your business is being called income tax. So you as a corporate body, as a company, limited company, you will call it company income tax. But for individual person that is paying from his or her salary or from his or her profit that he earned from the business is doing, he or she is doing as a self-employed, you will call it personal income tax. So any tax you pay directly from your income profit is being called direct tax. And if you pay it from the profit you earn from your sales of your assets, is being called direct tax. So that one we call it capital gain tax. Capital gain tax can be described as the tax being levied or being paid from the profit you earn when you sell your assets. Now, let me give you my example of it. Assuming my company now bought a land at the rate of 1 million naira, and now that it has yield, like maybe they are selling land in that area at the rate of 10 million, and I sold it 10 million. Now, for government to charge me capital gain tax, they will deduct the amount I bought the land from the amount I sold it. So the difference, which is the profit I earn, there is a 10% capital gain tax on it, which it will be paid to government once I sell it from the profit. But from next year, January 2026, the government has increased the rate of capital gain tax to 30% of the profit you make on your on the sales of the assets. But there is a clause, there is an exemption there. So it's not that, no, if online now everybody is carrying a rumor that this government want to kill us with tax come January 2026. That is not how it works. The tax from next year has already given relief to both individual and corporate body in a drastic way. For individual, when I sold the law say whenever I'm selling my assets and I earn a profit from it, if the profit I earn from it did not up to 150 million naira, and be exempted from payment of capital gain tax. What we mean by exemption is you are prevented to pay, you are not allowed to pay. The law shield you, the government shield you with their law not to pay in as much the profit you make from the sales of your asset, either sales of the building, sales of machines, sales of office equipment, or sales of your shares capital that you bought, all these shares you bought in all these big companies. If you buy their shares and when you sell it, all the total profit you earn or you make from it did not up to 150 million naira. The law prevents you from charging from payment of capital gain tax. So that is the clause that is there. So those people that are to pay capital gain tax from next year January now are people or company that make 150 million naira upward gain from the assets of their business they sold, or from their assets they sold, either shares or fixed assets. So once you are not making up to 150 million naira, the law prevents you from payment of capital gain tax come January 2026. That is a big relief that the government granted both individual and corporate bodies. And now for company income tax. Company income tax is a nature of tax being paid by a corporate body, a limited or unlimited company, or a limited by guaranteed company. This company income tax is being paid from the profit the company earned or the company made at the end of the year. Before the government can assess you, or you can assess yourself, or the government assess you on the tax to be paid on your profit. That is what we call allowable expenses and non-allowable expenses. Also, there is allowance that the company granted you on the assets you are using for your business. If you have like you put all your furniture and fitting in your company, the chairs and the table is being purchased in the name of the company. The system, the laptop system, the AC, everything, the gadgets you are using in your company for your business is being purchased in the name of the company. There is a rate that the law granted you as an allowance at the end of each year on those assets, and the allowance will be deducted from the net profit from that is what we call adjusted profit that your company make. The reason why the government granted you this relief is that that when you are using an asset, that's what we call depreciation, which is the deduction in the value of an asset that you are using. You only know that the asset, maybe the laptop or the chairs and table you are using in your company, if you want to sell it, it has reduced in price. But there is no way you can get the value for that deduction, the reduction in price, which we call depreciation. That's why the law say this nature of depreciation is not good for a company. It cannot sustain or promote a company to be in business continually. So the law, in the prerogative of the federal government, create and establish what we call capital allowance on assets you are using for your business. So at the end of your business activities in a year, whenever you disclose a net profit, the law says you should add back that depreciation value or depreciation cost that your company has incurred on the asset for that year. Then there is a capital allowance, there is a rate and law that back that capital allowance up, which if you use the rate to calculate it, any amount you get from it, if those amount is higher than the adjusted profit that your company have, the law say you should now look for two-thirds of that profit you make, remove two-thirds of it from that profit. That means if you divide the profit, your adjusted profit, into three, which we mean by three places, the law says you should take two part of it. Is on the remaining one part of it, which we call one third, that the tax will be charged on. And peradventure that maybe last year, let's assume that 2024, you make a loss in your business activities and it is being proven after the adjustment and everything. That's what we call tax loss. So once the system said that the law say if you make a loss genuinely and it's been proven based on your documentation, your accounting book, it's been proven that really your company make a loss, the system will remove the loss you make in last year, we deduct it from the profit you make in this year before they can tax you. And also there is a capital allowance that your company is entitled to based on the assets you are using for the company. Once all the assets you are using for the company in operation is in the name of the company, the law allow you to charge capital allowance. So both you as a business owner, maybe as an enterprise business owner or as a limited, before they can tax you on the profit you make for your business, you must prepare your account, which an auditor will audit it and see that it's real. If the auditor know more about the tax, the auditor will help you to compute both your capital allowance and the tax before the law can tax you or before you can pay tax on it. So that is how it works for limited company. And also the same law of that capital allowance work for enterprise, which is a business thing. Once you have all the assets you are using for your business operation is in the name of your business, before you can be taxed by your state government on the profit you make on your business name, as a registered business owner, on the profit you make from it, you are expected to prepare an account which the auditor will audit it and see that you are saying the right thing, you disclose everything. Also the capital allowance will still work from it because you are using those assets. Those assets are in the name of the company and you are using them for your business activities. So the law say you should prepare your account, and for you to have a good account, that means you must have a good accounting record. You may not be an accountant, either as a business owner, self-employed person, but you must try to have register. Either you have it on soft copy on your system, you can create Excel or Word. Be typing every items, every expenses you incur in each day. Put it there or you write it down on the book. Every sales you make in each day, write it down, write the date, so sales now, another sales. At the end of the day, add it together to know the total sales you make in each day. So the same thing applies to all the expenses or the purchases when you are buying the product. When you are buying the product you want to sell, record it. Okay, 5 bag of garri from Bodija cost this amount. You write the date and the what you bought in the market. And when you are selling it, try to write it down on a paper or on a higher education. At the end of the month or at the end of the year, this will enable you to do a proper account. If you don't know how to do a proper account, you can get in touch with the accountant. Then if you want to audit it, that means you have to get in touch with the what? A certified or a chartered accountant that will help you. So in Nigeria, we have two bodies that can audit your account for you. We have ICAN and we have ANA. So the two are licensed by the government to be an auditor, which they can help you to prepare your account and help you to consider the capital allowance you incur on the asset that is in the name of the company, which you are using for the business activities of that company, either enterprise and the limited. And it's the remaining amount, which we call taxable profit, that the government, both the federal government or the state government, can tax you for. The federal government tax you if you are a limited company or unlimited company or limited by guarantee. The state government tax you if you are a business, registered business owner on your. If you are a self-employed person, you prepare your account, the profit you make from it, the government will tax you from it. And also there is a law presently, the law says for either limited or if your sales activities for the whole year is not up to 25 million naira as the limited company, you are not expected to pay company income tax on the for the company for that year. If your total sales for the whole year is not up to 25 million naira, the law prevents you from payment of corporate tax. But from next year, the government in their infinity mercy and in their prerogative have increased it to 50 million naira. So from next year as a limited company, if your sales activities for the whole year is not up to 50 million naira, you are not paying any company income tax. But that does not stop you as the director of the company not to pay your personal income tax to the state government where you are operating from. So the same thing goes to the enterprise. If you are not up to 25 million naira now, the law prevents you from paying payment of VAT, but you must disclose it. Also, as a business owner, you have to pay personal income tax to the state government you belong to. And for them to get it as a business owner is from the profit of your business that you will deduct. So our advice for any business owner now is for you to have not to be charged excessively, for you not to pay excess tax, you are expected to have a good accounting book. And also, do not allow any company's money to go directly to your personal account. Don't let company money go to your personal account. Let business money, company's money goes to company's account. Register and open a bank account for your business too in the bank. All the sales activities of the company, let it goes to the company's account. And also, for easy access of your business, once you are doing transfer, maybe you are buying something and you don't want to go with a huge cash, you want to transfer to this supplier or the person you are buying from. Whenever you are doing transfer, always indicate the purpose. You know there is a remark when you are doing online transfer. Put a remark there. 50 you are okay, maybe purchase of cement, purchase of rice. This anything you are buying, always indicate the reason for that transfer. This will help you whenever the tax authority come to reconcile your account with the account you have prepared to know maybe you make a profit or loss. If you make a loss also, there is no way the government will tax you except if you are collecting salary from the company. So we employ you to always pay yourself salary at the end of each month. And when you are paying salary, either you are paying it to your staff or you are paying it to yourself, always indicate it. Salary for the month of March 2020 this, salary for the month of February 2020 this, always indicate it. So this will help you whenever they are doing tax monitoring or tax exercise in your company. And also ensure you have a proper accounting book. So as an employee, you are expected to pay tax on your salary. Before your employer can pay you your salary at the end of each month, your employer is being saddled with the responsibility of deducting what we call pay as you earn. on it. So you people call it payee, which means pay as you earn. Pay the tax as you are collecting the salary. The higher the salary you get, the higher the tax you pay. So you are not the one to pay by yourself. Before your employer can pay you, the law instructs your employer to calculate tax and deduct the tax from it. But there are some allowances that the law granted you before they can deduct tax from it. Presently, if you are not earning up to 50 million naira, if you are within the threshold of minimum wages, the law prevents you from payment of tax. So that means your employer will not charge you payee on your salary. And also, presently the law granted you what we call consolidated relief allowance CRA of 20% of your yearly salary plus 200,000. So that is the allowance the law granted you. And if you are contributing to pension, you are contributing to all this health insurance, before they can tax you as an employee or as a business owner, they will consider that they must deduct all those maybe insurance policy that you are doing, health insurance you are doing, maybe you are contributing to national housing scheme. The law said the employer should consider it, deduct it from your annual salary before he can tax you. So it's from the remaining amount after they have deduct your consolidated relief allowance, all the deductible expenses like insurance, health insurance, insurance policy, housing scheme contribution or pension. After they have deducted that, it's on the remaining amount they can tax, and there is a rate to tax it. Not that they will just look for 10% or 15%. No, there is a rate for each amount that remain. But from next year, anyone that is collecting below 70,000 naira, or even if you are collecting 75,000 naira, the law apprehend has exempted you from payment, but they must compute it, they must calculate it on the paper of the salary schedule to see that you are actually exempted. Part of the allowance the new tax law grants you from next year January 1, 2026 is the government has brought back what we call rent allowance. Now, for them to calculate rent allowance, the law says it's 20% of your yearly salary. So if you are collecting 100,000 naira per month, that means in the whole year your salary is around 1.2 million. The law says that the employer should look for 20% of it, which serve as your what? As your rent allowance. But if you are collecting above 100,000, 500,000, the law says they should look for 20% of your yearly salary also. But the rent allowance must not be more than 500,000, which your employer will remove and give you. That means on that rent allowance, what the law says they should not tax you on it is a relief. So they will deduct it from your salary. So you are collecting like 100,000 per each month now. That means 20% of 100,000 of 1.2 million is 240,000. They will deduct 240,000 from 1,200,000, which it remain around 960,000. Now, if you are contributing to pension, you are contributing to maybe you have any insurance policy you are doing, the law said you should submit the document of insurance policy, and the annual premium that you pay for the insurance policy should be deducted from it. If you are doing health insurance, the annual amount you contribute to the health insurance must be deducted from it. If you are doing pension, 8%, the annual pension amount, which is 8% of your salary that you contribute, must be deducted from it. So at the end, your money may be a bit above 800,000, and what the law now gave you no additional relief on it before you pay tax. The first 800,000 naira from the remaining amount, the law prevents you from payment at all. That means they call it zero tax, which is zero tax on the first 800,000 naira. What it means is that the law has instructed your employer not to tax you. The law has instructed anyone not to tax you on the first 800,000 naira from the remaining amount. So you as an employee, you benefit from that 800,000. So if you are earning above it, that means it will remain a little, and from the remaining amount, that's what they can tax you from. So you are getting allowance of rent allowance of 20% of your earned income, and also you are getting allowance from that 800,000, which they will not tax at all. So your rent allowance is 20% of your yearly salary, but it must not be more than 500,000. So those are the allowance the government, the new tax law grants you from next year, January 2026. So the new tax law bring a relief on taxes to people a lot, both the limited and enterprise. So as a limited company, the present tax law we are using, that's what we call minimum tax law on it. And the minimum tax law affects any company that has been in operation from 4 years above. So if you are in operation from 4 years above, presently that's what we call minimum tax law. So what the law do is, once you do a self-assessment of your profit, once you calculate the profit, the tax supposed to pay on the remaining profit you have, there's what we call minimum tax law, which is 0.5% of your turnover. So if you calculate it, the one that is higher, that is what you will choose and pay to the government. And in most cases, minimum tax law is usually higher than your self-assessment. So this minimum tax law affects a lot of business, like those people that are in what we call it, health sectors, like pharmacy, like hospital, like those people that are in petroleum sector, all these petroleum marketers, those petrol stations. The minimum tax law affect their capital, because when you calculate minimum tax law, it deepen is hand into the capital of that business. So this thing usually affect a lot of business, and it crumble a lot of business, which made a lot of business to be running to become an enterprise. But in the prerogative of the Mr. President, he established a tax reform committee, which they look into the present tax law we are using, and they abolish anything called minimum tax law, come with the effect from January 2026. Nothing like minimum tax law on the transaction of 2026 again. So we are only paying the last minimum tax a corporate body will pay once you are in business from 4 years ago is on this 2025 audited account, which you will do in 2026. But from 2026 business transaction, come 2027 that you submit 2026 business activities, you are not going to see anything called minimum tax law again. That is how it concerns direct tax. On indirect tax, that is what we call the indirect tax, is the taxes you pay indirectly, maybe through what you are consuming or through what you are buying. If you are buying a product to go and resell it, the law says you will pay VAT on it. So part of indirect tax is VAT and custom duty. Now, what do we mean by VAT? VAT can be described as the value added tax being added to this price of this goods you are selling to your customer, or the value added tax being added to the services you are rendering to your clients or customers. So you as a professional, if you are rendering a tax services to your customer, the VAT there is you have to charge VAT, which is the tax value of the services price you are rendering to your customer. That's what we call VAT. So, and once you charge VAT, you must remit it to the government at the end of the month. But on the VAT issue, there are some companies that are, if you are not presently, if you are not up to 20, your yearly income or yearly sales is not up to 25 million naira, the law prevents you from charging it and from paying. But you must disclose your sales income at the end of the year, and at the end of each month, sorry. And if you are into agricultural business, either services or operation, if you are into educational business, either services or operation, if you are into health insurance services or operation, the law exempts you from charging and payment of VAT, but you must disclose it to the government at the end of each month. We will discuss more about VAT in our next episode. Then we will talk purely on VAT, how the type of VAT we have and how it affects your business. Thank you for listening. See you next time on the same channel, on the same program, which we call You and Task. Have a great day. God bless you. Bye for now.